As a parent, you want to provide the best future for your children. Now, this can be quite a tasking job with the rising inflation and changing lifestyle. And objects that are associated with our daily life have continued to become more and more expensive over the years. There can't be any good day to start saving for your children other than now. Let's over here talk about the power of compounding that work actually like a magic for your children's tomorrow. To design the right investment for your younger ones, we have Aditya Shah, Chief Investment Officer of JST Investment, joining us now. Aditya, good evening and welcome to the show. We are talking about investing for your children, which seems to be the biggest priority and the only prime priority of most of the parents. The kind of trend that I want to discuss with you now on the show is a lot of parents make investment on the name of their children, what kind of investments are we here talking about? What kind of investments are actually done on the name of children?
Good evening, Sakata. Can you hear me, right? Sakata, can you hear me?
Yeah, I can hear you.
Yeah. It's a good idea to start investing in your minor child's name as soon as they are born, so that long power of compounding, about 15 to 18 years of compounding, is there for you. So, in what products can you invest in? Across all products, this option is available to invest. What you really have to do is that minor has to be attached to a major. For example, if you have a son or a daughter, that account will be attached to a major like the husband or the wife. It will be attached to that. The husband or the wife can continue to invest in the child's name. Any investment gains that accrue, and if you redeem them before the child turns a major, they will be attached to the major's account, and you will have to pay capital gains tax, or if it's in a red debt product, it will get added to your income. Once a minor turns
Got it.
major, you have to apply to the income tax for a PAN, and the investments get transferred into the major's account, and then a new entity is created, and that's how these investments are taxed in the name of your child. So I think it's a good option to start investing in mutual funds or direct stock or a whole host of other products that are available as well, like a PPF. You can invest in all of these products in the name of your money.
Aditya, I'm going to be taking a complete children future planning portfolio from you, but then let's talk about the investment instruments that you just mentioned and how to open an account on your children's name, on a minor's name, and how does it work. A lot of people we really interact with, a lot of queries that come on the show also. People usually ask about opening an account as a PPF. We talk about fixed deposit. A lot of people buy insurance policy on the name of their kids. How do these kind of investment instruments work when you buy all these things on your child's name? What is the procedure? How do you actually come out of it? Till how long are these investment options available for a minor? And once the child crosses 18, how do you give the hand over to the child? How does it actually go about?
So what you really have to do is you have to individually visit the office of all of these products. For example, let's say mutual fund. You can go and visit the office of CAMS or any of the mutual fund companies, and there you have to open an account in the name of your minor, saying that this account has been attached to the major, who is the father or the mother. The companies will accept these investments, and the money can flow in from the major's account until the son or the daughter turns 18. Once the son or the daughter has turned 18, you have to again visit the company. First of all, what you have to do is you have to apply to the income tax department for a PAN card. Once you have the PAN card and you have changed the status of your child from a minor to major in the bank account, you have to visit the bank and show them the Aadhaar. You will be able to change the status from a minor to a major. And then you have to visit the offices of all of these companies. Let's say a PF account if you're opening with a bank, or a mutual fund account if you're opening with any of the mutual fund companies. You have to visit them, and the account will then be converted into a major's account where all investments can be done by the major. and the gains will automatically accrue to the mutual. So this is a very easy process to do now. So I will suggest that do that so that you have long periods of compounding that are available for your child.
Sure, sure. One specific investment instrument which I want you to touch upon is Sukanya Samriddhi Yojana, which is actually for your girl child. That's a very interesting scheme for the bright future of your girl child to get her education done. How does this scheme work, and how can a parent open an account? If you could just highlight the main points here.
The main points are, in order to inculcate savings amongst girl child, the government has come up with a scheme called Sukanya Samriddhi Yojana, where for a period of 18 years for a young daughter, parents can start to invest in that product. It is covered under the tax saving options of ATC. What happens is you have to continuously invest every year in the name of your girl child, and the government gives you a higher interest rate. Last I checked, the interest rate was about 8.1% on the Sukanya Samriddhi Yojana. And once the daughter turns 18, the account will start to mature and the daughter will have that money in her name. Only girl child are eligible for this, and parents can invest up to 1.5 lakh into the Sukanya Samriddhi Yojana, and only one account can be opened across any bank. You can visit across any bank, and the banks will have the option of Sukanya Samriddhi. It is an excellent product for a girl child, and my advice to all retail clients will be, if you have a girl child, please compulsorily go and invest in this product, because when you invest in this product, it is tax free, and when you come out of this product, it will be again tax free. So it's a very good product to invest in. It has been created to help girl child have money at the time of maturing into an adult,
Okay.
so that they can use it anyway.
Okay, let's move on to the main course of this topic, as I would like to say. You have to give us a model portfolio. Now, for example, if someone wants to really start investing for their children's education or maybe a better future, what should be the investment time horizon? What should be the amount? How should you understand what kind of a goal should you be setting up, and what kind of a corpus can be accumulated with what kind of an investment amount? So there are a lot of words out here. Please help us out, Aditya.
Yeah. As soon as your child is born, I will suggest go and invest, because the first major expense that you will incur is by the age of 18, when your child needs to go for higher education. It may be in India or it may be outside India. If it is in India, then the goal should be anywhere between 20 to 30 lakhs. If it is abroad, upwards of 1 crore should be the target. So I am saying anywhere between 15 to 18 years of investments, if you are able to do, it is fantastic for us. How you should go about investments? If it is a girl child, number one product that you have to go and invest is Sukanya Samriddhi Yojana. Number two product that you have to go and invest in equities. If you don't understand equity really well, equity mutual funds. If you don't want to invest in equity mutual funds as well, index funds. A lot of your allocation towards your child's investment should be in equity mutual funds. Around 60 to 70% should be there. 10 to 15% should be in the Kanya Samriddhi Yojana. And again, other 10 to 15% you can go and park in the provident fund or this fund, right? So these are the three products which I really like. But my theme here, or with these things, we have a very long-term horizon. I will suggest that go ahead and invest in equities up to mutual funds. So the power of compounding
Okay.
over a period of 18 years is properly seen, and you get a good corpus by the time your child goes to higher education.
Aditya, could you also quickly name the funds that we should be investing and looking at different time intervals of investments?
The fund should be very diversified in nature. So I would suggest something like a Parakparik Flexi Cap fund, which is very diversified in nature, or you can go for a UTI Nifty 50 fund. You can also go for UTI Nifty Next 50 fund, which are index funds. You can go for a fund which invests abroad, which is let's say Motilal Nasdaq or a Motilal or a Mirai FANG ETF. You can also invest in a Mirai Asset Emerging Blue Chip Fund. So try to invest in a very diversified fund. Also include some index fund inside your portfolio, and an international fund which gives you an exposure to innovator companies in the US, and also serves as a hedge to the US dollar. So if you are able to build a portfolio of 4 5 funds, it will be fantastic.
All right, Aditya, that will be all. I mean, we have a lot of questions on this, but then we really have to move on to our viewer queries also, which is also the main aspect of this show. And while we have you, the first question that's coming is from Mithun Kumar. and he's asking this question from Gaya. He is 30 years old and his target is to accumulate 70 lakhs by 2040, and he's got his SIP done in SBI Focused Equity Fund and 3,200 rupees. He says that he has an SIP in Kotak Manufacturing India Fund also. It's almost about 2,000 rupees we're talking about here. And his next SIP is in Parag Parikh Flexi Cap for 2,500. Now he wants to know whether this kind of an investment amount is enough for his target that he wants to achieve till 2040. Aditya.
And if I assume a 10 to 12% return, the investor will only accumulate 60 lakhs over his time horizon, which is shorter than the investor's goal of 70 lakhs. So I would suggest he can do two things: either start to increase his SIP by at least 10% every year, or the other thing that he can really do is increase his time horizon by at least 3 to 5 years. Then he will be able to comfortably meet his goals. The second thing that I have noticed in his portfolio is he has on regular plans, so he must check who his investment mutual fund advisor is and consult with him about the portfolio that he's got. According to me, the portfolio is not properly aligned. He has to align his portfolio properly into three funds: Parag Parikh Flexi Cap Fund, UKI Nifty Next 50 Fund, and DSP Quant Fund. Equally split your SIP into these three funds. The existing SIPs you need to stop and realign here. And as you realign here, afterwards you can redeem the existing funds and move on to all these three funds. But again, be very consistent in your investments, be very disciplined in your investments, and you will be able to nearly reach it.
Okay, one thing I really want to understand is, since we don't have a lot of clarity in this question, by 2040 we really don't know what's the target that he's, what's the reason for 70 lakhs that he wants to accumulate this amount for. If you talk about Kotak Manufacturing in India Fund, what kind of an investor should actually put his money in this?
Ma'am, India is moving towards becoming a manufacturing hub, but there are a lot of problems as well. It is a very sectoral fund which gives a sectoral risk inside the portfolio. Generally, a retail investor must not invest in sectoral funds where sectoral bets are there. If the bets work, they work beautifully, but if they don't work, there is a downside that we have not generated any return. So only high risk individuals should start to invest in all these kind of products. A normal retail investor with moderate risk tolerance should always invest in a diversified fund, which is why I have already recommended all of those funds to the investor.
All right, let's move on to our next query, Aditya. And first up, I think we have the funds name that are coming up, and we are talking about Birla Sun Life for tax relief 96, 3,000 rupees SIP is going on out here. HDFC Tax Saver, 1,000 rupees per month. Reliance Tax Saver, 1,000 rupees per month. Reliance Gold Saving Fund, again 1,000 rupees per month. And Reliance Small Cap Fund, again 1,000 rupees SIP. Reliance Large Cap, Reliance Axis Blue. Reliance Large Cap has 1,000 rupees SIP going on. Axis Blue Chip is 3,500. ICICI Silver ETF Fund, again 1,000, and ICICI Technology Fund also, which is 1,500. We also have one more tax saver and one small cap, Axis Long Term Equity, Axis Small Cap, in both 1,000 rupees per month. Now the query is which fund should be out of the portfolio. For that we really have we don't have almost all the details to suggest, but then talking about tax savers, a lot of tax savers in the portfolio, Aditya.
Ma'am, as you correctly said, the investor has too many funds inside his portfolio, and these many tax saver funds are generally not required. So I generally tend to suggest, stick to one tax saver. So looking at the investor's portfolio, I have designed a portfolio of 5 funds. He can stick to Aditya Birla Sun Life Tax Relief 96 Fund. Then the other funds that are included in his portfolio will be UTI Nifty Next 50 Fund, Axis Small Cap Fund, Reliance Gold Fund, and Parag Parikh Flexi Cap Fund. Again, I am repeating the same thing. Do not include too many funds inside your portfolio. What will happen is you will keep paying expense ratio and you will never get superior returns in your portfolio. Try to concentrate your portfolio into 4 or 5 funds. and then be very disciplined and very consistent in your investments, you will do extremely well over a period of 10 to 15 years.
Okay, let's move on to our next question. And so the person we're talking about has started investing their money just last year. The amount of funds in the portfolio are Parag Parikh Flexi Cap, Access Mid Cap, Canara Robeco Small Cap, all 1,000 rupees per month. The target that the person wants to achieve is almost 1 crore in 20 years for retirement, and also a goal lined up for children education. Salary is almost around 27,000 per month, and can this be achieved by this investment in this portfolio, the kind of funds that are selected? And also, can foreign equity fund be a part of this portfolio, Aditya? That's the question.
So, ma'am, the present SIP that the investor is doing, he will not be able to achieve his goal. I assume a 10 to 12% return, which is a very nominal return. Again, looking at the exchange that the investor has got, that his salary is about 27,500, I will suggest that slowly increase the SIP and also push your time horizon at least by 5 to 7 years. That's the first point that I wanted to say. Again, in his portfolio, the funds are not properly optimized. So I have suggested three funds in his portfolio. Looking at his portfolio, which is Parag Parikh Flexi Cap Fund, Canara Robeco Small Cap Fund, and UTI Nifty Index 50. As for his question on investing in foreign funds, definitely today there is a good news that entities will be allowed to invest in some of the foreign funds as the limits from the RBI do get opened up. The investor can look to invest in a Motilal Nasdaq 100 ETF or a Mirai Bank ETF, whichever the investor feels good enough. But I think foreign investments should be part of your portfolio because innovator companies are all in the United States, and they also serve as a hedge against the dollar because the rupee will continue to depreciate over the next 10 to 15 years.
One thing I want you to highlight, Aditya, over here is what I'm also noticing in a lot of questions. A lot of time people don't have an alignment of what kind of a time horizon one needs to have for what kind of a goal, and most importantly, what is the amount of investment that needs to get into, because people seem to fix a goal, okay, but do not realize that it should be materializing or not, whether it's the right approach to have in terms of investment options. And even if they have the right investment options, they don't know the kind of investment amount that should be getting in. For example, the question that you just answered, the target is 1 crore in 20 years, but there's still a misunderstanding that how much can be compounded and how much inflation should be factored in. So what should be one line of thought or mindset when you set a goal and you decide on an investment amount?
That's right, ma'am. So what you have to really first do is identify your goal and identify at what time period the goal will come. For example, your child's education will always come when the child turns 17 or 18, right? If the child is 1 year of age, you have 16 years of compounding that is coming up. That's the first point. If it is an education goal, you have to assume an inflation of about 10 to 15%. And on the mutual fund investments or the equity investments that you really do, a nominal return that you can assume over this time horizon is about 10 to 12 years. Today, there are multiple options available over the internet to calculate the amount of corpus that will be required 15 to 18 years down the line. What I have seen is retail investors randomly calculating the amount of money that they will require 10 to 15 years down the line. Don't do that really. For each of the goals, assume the what is the amount that is required today and inflate it with the level of inflation. For example, on the education side of it, 10 to 15%. On the retirement side of it, if you assume an inflation of 10%, that is fair enough. On the
All right,
medical
now
expenses,
let's get on to the last query for the show, and we are talking about Ravi Ahuja's portfolio, who sent his details to us. So Aditya, his age is 33. The kind of funds he has in his portfolio are SBI Small Cap or DSP Equity Opportunities. We're talking about UTI Flexi Cap, and the amount is 1,500, which is going in all these three funds. Also, the SIP, the investment that we're talking about, he started in August 2021. So he wants to know whether the fund selection is good enough, and by 2040 he seems to have planned his retirement, and he wants to know if 1 crore corpus for the retirement would be achievable with this kind of an investment or not.
again, ma'am, with this kind of an investment and I assume 10 to 12% return, the investor will be broadly reaching at about 70 lakhs. So in my opinion, the investor will fall short of his
Aditya?
investment target. So therefore, what the investor should really do is increase his SIP as he starts to make more and more money, or he could delay his retirement. Again, the investments in his portfolio, as I have already said, we should include a Parag Flexi Cap Fund, a UTI Nifty Next 50 Fund, a Axis Small Cap Fund, and a DSP Quant Fund. These are the funds that he should be investing in.
All right. One thing that I want to understand from you is when people ask this question, if the fund selection is good enough or not, what would be the criteria for an investor to decide that?
Ma'am, if you are very, very young and you have many years of time horizon left with you, so what you can really do is you can go towards a mid cap and a small cap fund. But however, if you are in your middle ages or early later stages of your investment journey, you must not include a small cap or a mid cap fund. A flexi cap fund together with a large cap fund should do it for you. So your age is a very important factor in determining what kind of a fund that you are taking because it determines your risk profile. And once your risk profile is decided, then we can include a certain amount of funds inside your portfolio. As many years of compounding is possible, then include the riskiest fund inside your portfolio. But if you have not many years of compounding left, try to stick to a flexi cap or a large cap.
All right, so that will be all. Thank you so much for being a part of this show, Aditya, and not only explain us, you explained us investment stuff that one needs to incorporate when planning a financial portfolio, but also helped our investor form their financial portfolio. Thank you so much for being with us, and let's shift into a short break.